Hello everyone. Once again, let us start one more case study. Right now, we'll be doing case study number 22. Can we start? Yes, sir. Sigma Limited is engaged in the manufacture of cold beverages. The promoters of the company are very optimistic about the business, have, have expanded a sale of beverages across India, Africa, and Europe. The board of directors of the company has also decided to get the company listed on one of the European stock exchange. Additionally, the management is in talk with the company in the Middle East in order to acquire the controlling stake. The company is already preparing its financial statement under India. The first para is normally not relevant, but read it. Sometimes some important information might be given. Okay. Sigma Limited has two major plants, one in Bikaner, India, and other outside of Berlin. In 2015, the property prices has fallen significantly and the company had purchased land adjoining the Berlin plant. So they have purchased one land in Berlin. In Berlin, management has been debating on the use of land, that is whether to build an additional plant or to lease it out, but has not yet decided yes yet. We still are not decided that what will be the use of that property. Whenever the use is not determined, it will be always deemed to be held for capital appreciation. Therefore, it should be classified as investment property. The purchase price of the land was euro 2,50,000 as on 1st April 2015. The real estate market is flourishing in Europe and the fair value of land was euro 6 lakh on 31st March 2020. The euro INR exchange rate was 1:75 on 1st April and 1:95 on 31st March. The company believed that cost approach would be most appropriate so that frequent remeasurement of the property value is not required. However, as per India's 40 only we have cost model, so of course it will be classified as what investment property and we need to adopt cost model as per the requirement of India's 16. Means India's 40 says that apply cost model as per India's 16. Correct? Let's see what the question they have asked. So of course the fair value information is only relevant for disclosure purpose. Only for disclosure purpose. Additional information. The company purchased a machine high-tech for packaging purpose, but the management had changed its intention of use of this machine and decided to rent out the machinery. So can you say any machinery which is used for production purpose or held for rental to other, it will be always classified as PP. So be careful, even though machinery or any equipment is held for rental to other, it cannot be classified as investment property. It will be property, plant and equipment only, and India 60 will be applicable. The life of the machine is 8 years. The company has changed the method of depreciation on this machinery from SLM to WD method in the third year of acquisition. The accountant is unsure about the accounting treatment arising from this change. So of course we need to apply India's 8 and it will be accounted as changes in accounting estimate on a prospective basis. Chalega? Yes sir. Let's see. At a recent meeting, the board of directors has discussed a legal case which the two customers A and B have filed against the company in respect of the supplier product which was allegedly faulty with the company supplied in the last 3 months of the financial year. Those two cases have been filed by customer A and customer B. The management has estimated that if the action succeeded, the company is likely to have to pay out 20 lakh in damages to customer A and 18 lakh in damages to customer B. Means the management has estimated that if the action succeeded, action of customer succeeded, means the company will lose the case. Correct? The legal advisor of the company have reliably estimated that there is a 60% chance that customer A claim will be successful. So customer A claim will be successful means there is a high probability, there is a probability that we need to pay the amount, we need to pay the compensation. So there is a 60% chance that company need to pay the compensation. It means we need to create a provision for this. And a 75% chance that customer B claim will not be successful. So it means can I say 75% chances that we will win the case. So in this case, can I say there is no need to create a provision, but it will be disclosed as a contingent liability. I hope you are understanding. For such claim, the company has an insurance in place to cover against the claim. It is highly probable that any claim of the customer which were successful would be covered under this policy. Therefore, the management believes that if any liability will arise, the claim will be recovered from the insurance company. but any claim from insurance company is need to be accounted separately as a reimbursement asset. If the inflow is virtually certain, then this point will never affect the creation of provision. Understood? Yes sir, got this point. On 1st April 2018, the company has granted its CEO an option to take 900 shares or cash amount equivalent to 750 shares. So it is a question of share-based payment with cash alternative. If you remember, the minimum service requirement is 2 years. There is a condition to hold the share for a period of 3 years. If the shares are opted, so there is some post vesting period. There is some non-vesting condition, that locking period has been given on the transfer of the shares. The CEO exercised his cash option on 31st March 2020. So they want to exercise the cash option, means actually they want to receive the cash. So it is the settlement they have given. Particularly they have given fair value of shares alternative with restriction is 210. This is for what? Equity settlement. They have given the fair value because this is with restriction. Granted fair value on 1st April 2018 to 211. This is for cash settlement. Fair value as on 31st March 2019 and fair value as on 31st March 2020. Nothing is given. It means it is without restriction. So this is also for cash alternative. Let's see what the question they have asked. Point number 1. For the purpose of recognition, measurement and presentation, what is the appropriate classification of land adjoining the Burley plant? Of course, it will be classified as investment property. Option number B is correct. Got this point? Yes, sir. How should the company reflect in financial statement the legal claim pursued by the customer A and customer B? Let's see. Provision for legal claim amounting to 38 lakh. No, this is not correct. Provision for legal claim amounting to 20 lakh need to be disclosed in the financial statement. This is correct, but let's read the entire option. Provision for legal damage amounting to rupees 30 lakh need to be disclosed in the financial statement. Provision for legal claim amounting to 30 lakh need to be disclosed, means they are saying this will be contingent liability. This is still not correct, but they have seen provision. The word is only the option they have given wrong. It should be contingent liability should be disclosed. Provision for legal claim amounting to rupees 20 lakh need to be recognized and 18 lakh need to be disclosed in the financial statement as per contingent liability. So option number D is correct. Option number A was correct. Option number B was also correct, but they have not given anything about 18 lakh. So 18 lakh need to be disclosed as contingent liability. That is also correct. Option number D become more appropriate. What will be the classification of high-tech machinery acquired by Sigma Limited? So of course, it is held for rental to others, so it will be classified as property, plant and equipment. Option number A is correct. The change in depreciation method from SLM to written down value method in the third year will be treated as changes in accounting estimate. So option number B, prospectively as changes in accounting estimate, is correct. Point number 5, with respect to the option granted to CEO, the ESOP expense recognized in the company's profit and loss account for each year was. So we need to calculate it. Let us calculate it. First, they have given. First, we need to find out maximum equity. The maximum equity will be how much? 900 into 210. So 900 into 210. How much it is coming? 900 into 210. It is coming 1,89,000. Then we have to find out maximum liability. If suppose entire option is cash settled, what is the maximum liability? It is 750 into 211. 750 into 211. The maximum liability is how much? 750 into 211. How much? It is 1,58,250. So as per Ind AS 102, on grant day we need to first find out maximum liability, and any difference will be the equity component. So equity component will be how much? 1,89,000 minus 1,58,250, that is 30,750. So this will be considered as what? Cash settlement. This will be considered as for equity settlement. Means the accounting treatment of this will be as per SAR, if you remember, and the accounting treatment of this will be as per ESOP, if you remember. So can I say this will be reassessed at the end of each period, because this is liability component, and for this will not do the subsequent measurement. Got this point? So what will be the EB expense of the first year? So 750 into the fair value at the end of fair value option at the end of first year is 220. So 750 into 250 into 1 by 2. How much? 750 into 250 divide by 2. It is coming 93,750. Correct? One second. 750 into 250 divide by 2. It is coming 93,750 plus. Can you say this will be also recognized as an expense over the period? So 30,750 divided by 2. It is coming 15,375. Total become how much? Plus 93,750. So total become 1,09,125. 1,09,125. Year 2 it will be how much? 750 into what is the fair value at the end of the second year? It was 220. I have done wrong. It was 220. My mistake. One second. So 750 into 220. One second will do. 750 into 220 into 1 by 2. How much? So 750 into 220 divided by 2. Correct? It is coming 82,500 plus 82,500 plus 30,750 divided by 2. It is coming 15,375. Now it is coming how much? Plus 82,500. So 82,500 plus 15,375. It is coming 97,875. 97,875. Got this point? Then second year. However, second year is not required to calculate if the option of first year is only, means they have given for first year only in one option 97,875. Let's see what are the option given. Option given is what? 97,875 for the first year. So option number A is only correct. But let us check for second year also. What is the fair value at the end? Fair value of option at the end of second year? 232. It will be 232. Suppose they have given what? Two option as what? 97,875. So then you need to cross verify for year 2 also. So 750 into 232 is equal to coming how much? It is 1,74,000 plus 30,750. This is cumulative. Cumulative is coming how much? 30,750. The cumulative it is coming 2,04,750 minus this minus 97,875. That is coming how much? So the minus second year expense will be 1,06,875. Let's see the option 1,06,875. So option number A is correct. Got this point? Correct. I have done the entire calculation so that it become revision for you for the ESOP with SBP with cash alternative. Understood this point? Simple? Yes, sir. So let's see. Point number 1, option number B is correct. Point number 2, option number D, we have chosen that only. Point number 3, option number A. Point number 4, option number B. Point number 5, option number A. Done. Correct. In this, the last point was good because it requires thoda sa time to you need to be very much fast in exam because you need to complete. I will say you need to complete one case study in almost 10 minutes. Got this point? Yes, sir. Chalega? Yes, sir. So for this video, this much only. We'll meet in the next video with the next case study. Till then, bye bye.